Mm. Okay, hi, my name is Jessica Thomas. I'm doing this video recording to kind of discuss my discussion post for week 1. So we're going to do a brief summary of the major concepts from the chapter 1 and chapter 2 of the textbook. A quick content, we're going to talk about types of accounting, the accounting equation, double entry accounting, trial balance and its purpose, and how to derive a balance sheet from a trial balance. So for a summary of chapter 1 and chapter 2, it basically talked about the accounting basics, which entails recording, summarizing and interpreting financial information, 2 types of accounting, major types of accounting, financial accounting, which deals with preparing reports for external users, which are investors and creditors, and then managerial accounting, which deals with providing information for internal users of a company, such as managers, owners, to aid in the decision-making process. And the accounting equation is assets equals liability, which could be like debt, and equity, which is like the owner's capital, or net income. The equation shows how a company's asset is funded by debt, liability, or ownership, which is equity. For double entry accounting, this concept discusses how each transaction affects at least 2 accounts to maintain a balanced accounting equation. So you always want your total assets to be balanced with your liability and equity. For example, if you purchase inventory for cash, that reduces your cash, which is an asset, and that increases your inventory, which becomes an asset. Another scenario numerically will be if a business was to start with an asset of 20,000 cash, and then if they were to borrow 10,000 from the bank, that becomes debt, so that's liability, and the accounting equation will be 30K that the company is starting with based on the money that they borrowed and the starting capital. But dividing that will be the starting capital will be the equity, which is 20,000, and the money borrowed would be the liability, which is 10,000. So what is trial balance and its purpose? Trial balance is a report that details all the accounts in the general ledger, along with their balances, both debits and credits. The purpose of a trial balance is to ensure that the total debits equal to the total credit. It's also a good way to check for errors in and it also provides a snapshot of all accounts before preparing any financial statements. An example of a trial balance would be supposing the business starts with 15,000 capital brought in by the owners, and then they buy some inventory, some company equipment, maybe chairs or computers, and they spend about 5,000, which is paid in cash. And then over a period of time, they acquire about 4,000 in revenue without receiving payment, while also paying $1,000 in utility. That will be represented using this table where we have under accounts, we have cash, which would be whatever we have left from the 15K after spending office equipment and utilities. So that would be 9K. And then the revenue we made is going to be an accounts receivable for 4,000 because it's still pending, seeing as we haven't received it yet. And then we have the office equipment, utilities under debit, and then our credit would be the capital we started with and the revenue we've made. So you do always have to have the same balance at the end for it to balance out. So how do we derive a balance sheet from a trial balance? The balance sheet is a snapshot of the company's financial position at a specific date. This includes assets, liabilities, and equity. It is prepared by pulling up account balances from the trial balance and separating the accounts into assets, liability, and equity. Assets can include cash, equipment. Liability can include accounts payable or, utility bills, all that stuff. And equity is, for an example, owner's capital or net income or revenue earned. A good example here, using the trial balance from the previous slide. For our assets, cash will have 9,000, and then the equipment that we have gotten, 5,000, and then the revenue we've made, 4,000. So our total assets for that specific period of time would be $18,000. And then liability and equity, using the table from before, there was no liability. So our equity would be our owner's capital that we started with, 15,000, and then the revenue earned with or net income, which is calculated by subtracting your revenue from your expenses, which caps us at 3,000, and our total assets is 18,000 at the end of that specific period, and our total liability and equity is 18,000. Thank you, and these are my references.